Dear students, thank you so much for joining. We'll start in another 2-3 minutes. Just waiting for a few more students to join and then we'll begin. But what's up with you guys? How are you guys doing? Yes, Dipti, please tell us your doubt. Good evening, guys. Thank you so much for joining. We'll start in another 2-3 minutes. I have shared media link with you guys. So go ahead and follow recorded videos. We are recording the session. You'll get it on your LMS and on YouTube. I will explain each and every detail with you guys in a couple of minutes. Just requesting you to kindly stay connected. Another 2-3 minutes, we'll start. So I was saying I've dropped the social media handles to stay connected with future master classes. Go ahead and connect with us, follow, subscribe so that you stay connected and you can join the interested topics you are looking forward for, right? How's Sunday going, guys? What's up? What was special today? Ashwini, this class is being recorded. If you see on top of it, or if you join, you will get the notification this session is being recorded. You'll get the recordings. Don't worry. Biryani Sheikh is saying that's great. Why is everyone look forward for Sunday? Why you wanted to finish as soon as possible? Fish biryani. I do. Everyone is eating biryani today. Sunday is a biryani day, I guess. It's 6:3, 6:5 will begin. Rasam also, okay. What's up? All exams are done, I'm assuming. It's Feb now. I'm doing great. Was a little occupied with the sessions preparation. Thank you so much for asking. Exam mock test. What will you do with the exam mock test? You all know how to write exams. Exams are going on for Aisha. All the best. It's going to start, Harish was saying. I think in March, maybe, or Feb. No worries, guys. I'm sure you guys are prepared enough and you'll be, sailing through. So, all the best for all the people who have exams. What session we are planning for next Sunday? Haven't decided. 2-3 topics are there. Also, what suggestion you guys submit today on forms, we'll pick something from that also. Pass or fail exams are over. That's true. Interview series we can do. Cat, okay. It will start in 1 minute. Today's session is about investing. Mighty Meku. BBMS we have done, Bhavna, but if you need, we can conduct another session which is slightly advanced level. Basics are done. You can check old videos as well for the same. All right, guys, need 1 minute and then we'll start the session. Okay. Also, just a humble request for older participation certificates. If you guys will be asking these questions right now in the session, for older participation certificate, please don't ask in this sessions. We will keep separate sessions for, you have the Abhishek's number and you can actually check out with him about previous certificates. The session will end around 7:30 or something. So please don't ask about these questions as well. Anything else, if I can clarify before we start, certificate link will be shared at the end. So if you are connected throughout the session, then only you are eligible. We get to know this meeting is recorded, your attendance is being tracked. We don't talk like without any facts and figures. So everything is being recorded: how many minutes you are joining, what time you joined, what time you exited, which email ID you use. So we know if you stay connected, then only you're going to get the certificate. I'm telling you well in advance. So that's there. Just give me a moment and then probably we'll start off. Okay. Hello, everyone, and a very warm good evening, ladies and gentlemen, and welcome back to Elevate's Weekend Masterclass, your weekly dose of knowledge. I am Priyanka, your host for this session, and we welcome you all on today's session, which is Fundamental of Stock Market. A lot of you were requesting for a practical session, so here we are with one. And as the name suggests, it's on stock market and trading for beginners. Before we begin, how many of you guys trade or deal in stock market, or at least check what's happening in the market? Can you quickly drop yes, no, thinking to start or something like that so that we get to know about it? No, okay. A lot of people saying yes as well. So what do you guys do? Invest, trade, or like read, check? Just drop, read, or check, or invest, trade, something so that we get to know. Sujit invests. Okay, Mamta invests. That's amazing. Rahul invest. Nothing for now. Okay. You all trade. A lot of people have started. That's amazing. That's amazing. So, guys, what's your understanding says about it? Should we invest it, or it's too risky, or like how do you see? Yes, Tanuja, we are here to drop better knowledge for you guys. Some people think it's risky. Okay, moderate. We should invest based on some strategy, investment, high risk, high profit. That's amazing. So you all know how the things work, right? Little bit. Well, I've read all the answers, and now it's time that we figure out the answers actually. Like, since we have some idea about what's the class gonna be, now we'll be learning how it is done. And who better to hear it from an expert, right? So I'm gonna take this opportunity and would like to introduce to our today's expert, who is none other than Mr. Amit Shah, a lifelong learner and educator of finance, management, accounting, and economics. He has previously worked in various finance roles as manager, tech lead, ERP, and BFSI at AppLab, lead consultant, finance enterprise solution at Symphony Services, and many more. And we are really, really glad to have him here today with us. As this was one of the most requested session, so we got our best mentor for the same, and he is one of our in-house finance mentor as well. So, without spending any extra minute, let's get straight into today's masterclass. Mr. Amit, welcome to the masterclass, and the session is all yours.
Thanks, Priyanka. I hope everyone can hear me. So
Yes,
I'm excited to know that there are many students now, around 290 so far the count is, and I hope everyone can hear me, guys. Uh, so here I start. We will take up your questions because many of you invest in the stock market or in crypto, which I was just going through and checking it and got to understand, and some other avenues. So wherever you have any doubt in between, though we can address that, but if it takes longer, then we will shift them at the end of this session. That I think is fair. So let's start. I hope you all can see the screen. So the first thing that is for those who do not invest, those who do not have much idea of investment avenues, stock market, securities, and all. So quickly we see that the securities which are traded in stock market or in capital market are equities, that is common stock. Then we have bonds and debentures. Bonds and debentures technically are same, but in India we term as debentures when they are issued by a company, and when they are issued by a government we call them bonds. If you do not want to invest directly in stock market because you do not have much expertise there and you do not understand much of financials and all, then it's always advisable to invest in a stock market by minimizing your risk, and for that you should go and invest through mutual funds, that is asset management companies. There you have expert where you pool your funds, you invest there, and on the funds that you have invested in a mutual fund company, those funds then are routed to a stock market. And this job is done by experts, a team of experts, so they know where to invest, from where to, uh, you know, uh, liquidate their investment, that is, take out their investments, and so on. Derivatives is part of futures market where you fix a deal today for a delivery or for an exchange in future. So equities, if I talk about equities, is by purchasing equity shares of a company, you become one of the owners or shareholders of that company, and this is how you enjoy the voting rights in that company and also enjoy share in profits of that company. So whenever that company earns any profits, a part of that profit is also given to you, and that is called dividend. By owning equity, the other benefit that you have is that the other monetary benefit is appreciation. That is, you buy a stock, an equity share at a lesser price, and then you sell it at a higher price later in future. And this is how you earn the difference of the selling price and purchasing price. Bonds, on the other hand, but yeah, about equity, one more thing I should add here is that it is the most riskiest investment in stock market. Your money can grow, your money can go to zero, and you will have nothing out of your investment. So that risk you should be ready to take, and then only you should choose equity shares as your investment avenue. If I talk about bonds are basically for those who want safe investment, who do not want to run after profits, but they want a certain, a consistent amount of return year on year on their investment, and they invest in bonds. So when I talk about bonds, it means I'm talking about here the bonds which are issued by governments, whether it is a state government or a central government. So when a state or central government needs funds, they go to the public and borrow money from the public. And for this, they issue some certificates to the public, and those certificates are called bonds. Now, in bonds, the money borrowed by the government is mentioned, along with the rate of interest payable on these bonds every year by the government. Since you know that it is issued by the government, there is no chance of any risk at all. So your money is absolutely safe. Even government bonds, investment in government bonds are said to be the safest investment much safer than investing with any government or public sector bank, whether it is State Bank of India or any other bank. Since the investments are the safest, there is no risk at all, and therefore the return would also be very low. So the rate of interest given by governments on bonds is the lowest in the market. But yeah, your investments are safe. So those who are orthodox investors, those who do not want to take much risk, they want a certain fixed return consistently over certain years, they usually invest in bonds. Apart from the public, the biggest investors in bonds are all the commercial banks, whether they are public sector banks or private banks like Axis Bank, ICICI, Standard Chartered, and so on. They also have to invest because of some regulations, because of some banking regulations. They have to invest in bonds. The idea is basically to keep the some portion of deposit holders' money safe by passing it on to the government. If I talk about debentures, with this other form of bonds, they are issued by companies. Again, it is a way to borrow funds from the public. So, by issuing debentures, a company borrows money from the public and promises them to pay interest at a certain rate regularly over the life or over the tenure of the debentures. They have also some amount of risk, but not as much as is involved in equities, because against bonds or debentures, companies give some collateral security to debenture holders, that is to the investors, whereby they say that in case they do not pay interest on these debentures in a year or fail to repay the borrowed sum, the borrowed amount after a certain date in future, which they promised while issuing debentures, then the public, the investors can recover their money by selling off some assets of the company. This kind of security, this kind of cushion is not available in case of equities. When you invest in equities, you are not given any kind of collateral security by the issuing company. So this is the basic difference between equities and bonds or debentures. Mutual funds, I explained you that a little about it. So if you are not expert, if you do not understand much of stock market, if you are not good with financials, you cannot understand financials of a business, you cannot interpret financial information and economic information, then it's better for you to invest through asset management companies. Asset management companies, they have a large pool of funds that they get from investors, those who do not have much experience and expertise of stock market and their securities. This pool of funds by these asset management companies is invested in stock market, in equities, in bonds, in debentures, and in some other securities as well, to keep the fund balanced so that they could pay back the returns to the investors who invested their money with these asset management companies. Mutual funds do not promise you any return. They have some past history. Based on that, you can choose a particular mutual fund company, that is asset management company, based on their historical returns, what they have given to their investors in past. Based on that, you can choose with which investment or with which asset management company you should go. They also do not give you any kind of collateral. They clearly mention that the money that you are giving to them is absolutely without any security and full of risk. So you should also be wise enough to invest in mutual funds. And for that, even though you do not have much knowledge of financials, then also just by looking at their past track, the past records as how they have given returns to their investors, you can invest in mutual fund companies. Derivatives, on the other hand, is for trading of any financial security, be it equity shares, debentures, or any other physical asset. It can be a commodity, it can be a bullion item like gold or silver, or any other thing. It can also include a foreign currency. So if you want to trade in a security like equity shares or debentures, or if you want to trade in a commodity including bullion items, as I said, the precious metals like gold, silver, and all, where you want the delivery in future of these items, but you want to fix the price today, then for you, derivatives market is there. The instruments of derivative markets mainly are futures, forwards, and options. So that is again a big topic where there are a lot many strategies, lot many things, lot many terminologies to understand. So that we may cover up in any other session. So I go ahead from here. If you have any doubt as of now out of this, you can ask, guys. And you please have to speak up. I think Priyanka, they are allowed to unmute themselves. Am I correct? Priyanka, are you there? So guys,
Yes, Amitji, is there any problem?
yeah, I was just asking if students are allowed to unmute themselves to ask anything out of the first slide, which I have just completed. Uh,
Okay, we can provide access, but if there's anything, they can put down it on the chat box and we can take this up. Anybody
Okay.
has to say anything? If you raise hand, I can particularly unmute one person.
Okay, so we go ahead from here, and I think Priyanka, the better would be to take up all the questions at the end of this
At the
session.
end.
Yeah,
Right.
yeah. So, the entire stock market can be classified broadly into two. One is primary market, and second is secondary or stock market. The secondary market actually is called stock or share market. In primary market, we have only two participants on the two sides. One side we have the companies needing funds, either in form of shares or debentures. They go to the public. How do they approach public? They approach public through print and electronic media, where they publish a big document that is called prospectus, and through prospectus they invite the public to invest in their shares or debentures. So there is no one in between the issuing company and the public, and this is called primary market. In primary market, when a company very first time issues its shares or debentures, though debentures cannot be issued by a company before issuing any shares at all, but yeah, when it goes to public very first time to have money to raise funds from the public by issuing its shares or debentures, that is called IPO, that is initial public offering or initial public offer. Public, knowing the information, the prospectus from electronic or print media, they go to their local stock broker. You must be knowing various stock brokers are there these days, whether it is Kotak Securities or Motilal Oswal or Sher Khan or Aryan Securities and many more. So in every tier one and tier two cities, we have offices of these stock brokers or their sub brokers. An interested investor can go to any of these brokers and can have a form of the company issuing its shares or debentures, can fill that form duly, and along with the form can give his bank information or can attach a check or demand draft with the money that he wants to invest in that company, and can deposit the same form along with money details or check with the local broker. So this is how money is provided by the surplus funds, the savings are provided by public to these issuing companies. Now, once you invest in shares of a company, since with those money, the company purchases various assets, whether it is land or building, plant, machineries, vehicles, raw materials, stock for production and for sale, and therefore company cannot pay you that money back. If an investor suddenly needs money, where he should go? And for that, we have secondary market, that is stock market. The main function of a stock market is to provide liquidity to the existing investors, those who want to take out their money from the investments. So they go to the stock market as sellers, and there they can sell their shares. Now, this has nothing to do with the issuing company at all. Company has issued its shares, has taken money from the public. Now, those who invested in the shares, they become shareholders of the company. In case they want to liquidate their holding, in case they want to have their money back, they have to go to the stock market where the shares are listed or the debentures are listed, and they have to sell off their shares in that market. In this market, on the other side, we have those buyers who earlier could not buy shares or debentures of the company when the company issued these shares or debentures through IPO, or they invested earlier but now they want to purchase more of the shares or debentures. So they are the buyers on the other side of the stock market. So in stock market, we have in one side the sellers, those who already hold, those who already have shares or debentures of that company and want to sell them off to have their money back. And on the other side, we have buyers, those who are still interested to invest in that company. So they trade with each other without knowing them personally, because in between there is the market, that is the exchange, stock exchange. So through stock exchange, they sell and buy these securities. And that market is called secondary market. Now, how much money an investor will get back out of his investment, that totally depends upon the stock price. The stock price prevailing at the time of selling or buying. And that price is made up of mainly because of the forces of demand and supply of that particular stock or debenture. If demand is high and supply is less, then the price would be more. And if supply is high and demand is less, then the price would be less. So, how much money you will get back out of your investment, that totally depends upon the prevailing market price. The key players in this market, that is stock market or capital market, are the issuing companies, those who need funds. Then we have, on the other side, we have investors. These investors not only include general public like you and me, but many big financial companies, whether they are commercial banks or insurance companies, those who have big pool of funds with them, mutual fund companies, that is asset management companies, provident funds, they all invest in stock market. To facilitate trading of shares and other securities in the stock market, we need stock exchanges, and they are there just to facilitate liquidity, that is, to sell off your shares which you are already holding, and for others to make them buy the shares if others are ready to sell them. So, this is the job, this is the function of stock exchanges. For that, they take a certain fees, which is very minimal fees in percentage, to regulate all these, that is, the companies, the issuing companies, or the companies needing funds, stock exchanges, brokers, and investors. We need a regulating agency, and for that, we have SEBI, that is Securities and Exchange Board of India. So this SEBI acts as a regulator of the entire stock market. It issues various guidelines time to time for the issuing companies, for the investors, for the brokers, for the foreign investors. So I hope guys you have understood little about primary and secondary market. You have got some idea about it. So today if you want to invest in any share, let's say you want to invest shares of Infosys or Tata Motors or Zomato, you have to go to secondary market and whatsoever be the prevailing price of these shares, at that price only you have to purchase. How to purchase that, what all you should have for that, that also we will include in today's session only. So I'm moving to the next slide. Stock trading is buying and selling of stocks, that you all understand. Now this trading is of two types: intraday trading and long term investing, that is delivery based trading. You must understand the difference of these two. Most of the investors, those who are novice or those who are new to the market, they do not understand it, and because of that they lose a lot of money. Intraday trading is the buying and selling of securities on one single day only. In the morning you buy a security, by the end of the day you have to sell that security for sure. If you do not sell it yourself, the exchange itself will sell it. So in India, some of the stock exchanges are Bombay Stock Exchange, that is BSE, National Stock Exchange, that is NSE. We have Calcutta Stock Exchange, we have Ahmedabad Stock Exchange, we have Chennai Stock Exchange, and many more, but most of them are regional. The national level stock exchanges, where most of the securities that you see around you are listed, are Bombay Stock Exchange, BSE, and National Stock Exchange, NSE. Now, when you do intraday trading in any exchange, that is Bombay Stock Exchange, and suppose in the morning you purchase a share, let's say you are purchasing 20 shares of Tata Motors, by the end of the day, that is before 3:30, the time when the market closes, you have to sell 20 shares. If you do not sell, the exchange, that is BSE, will sell it itself at that time's prevailing price. Whether you have any profit or loss, exchange does not take care of that at all, is not concerned with that at all. So that is called intraday trading. In intraday trading, you can also do first selling and then later you can do buying. So you do not have any share with you, yet you can sell them, because you are assuming that by the end of the day, the price will be lesser than what it was in the morning when you were selling it. So selling without buying is called short sales. You sell in the morning, let's say share a share of Tata Motor at a price of, for example, 400, and you are assuming that by the end of the day, the price would be much lesser than 400, and then you will buy it. And this is how, with the difference of selling and buying, you will earn profits. This is intraday trading, guys. So when you invest in share market through any broker, you must be knowing that you can do the investments sitting from your home only or any other place. You just need an electronic device that is connected to your broker. So through your mobile phones or your laptops or computers, you can do investment in stock market. So when you invest in a stock market in any of the securities, it asks you whether you want to do intraday trading or delivery based trading. That is long term investing. If you click on intraday and you buy some shares, by the end of that day itself, you have to sell them. If you sell them in the morning, then by the end of the day, you have to buy them. If you do not do so, means if you do not square off your transaction which you did in the morning, the exchange itself does it. So this is intraday. Intraday usually is done by those who are not much interested in any security. They just for the day have understood somehow that price of that particular stock will fall or will rise, and therefore they do the intraday trading for short term profits. But these profits may also get converted into huge losses. So usually intraday trading you should avoid. The next one is long term investing, that is delivery based trading. In delivery based trading, today you buy a stock, today you buy a security in a stock market. It would be delivered to you in your demat account after 2 days from today. And money will go off from your bank account within 1 day from today. In case of intraday trading, there is no delivery at all. You will not get any shares at all in your demat account. Demat account is like a bank account only, in which you have your purchased securities, whether it is shares, that is equity shares or debentures or government bonds. They all you can see in demat account in electronic form, in digital form. And when you sell, the number of shares that you have already sold, they get reduced from your demat account. So demat account is not the account of money, but it is account of shares where your purchase and sale of securities is recorded. To invest in stock market, to trade in stock market, you must have a demat account, without which you cannot invest in stock market. Facility of demat account these days are given by all the banks, whether it is a government bank or a private bank, they all give you that facility. So through your bank only you can have a demat account in your own name. In delivery based trading, that is long term investing, security actually comes in your demat account that you buy. So when we say delivery based trading, it means you actually are interested in that security. You want to hold it for some time, for some days or for some months or years. And therefore, while purchasing that security, you choose delivery based trading in your on your screen. And when you do so, when you purchase some shares, let's say you're purchasing 20 shares of Tata Motors at the prevailing price, assuming it is rupees 400, then these 20 shares will reflect in your demat account after 2 days from today. And money will go off from your account. That is 400 into 20 means 8,000 rupees will go off from your bank account, which is linked to your demat account within 1 day. So this is delivery based trading. When you want to sell the shares that you purchased earlier, again you have to choose delivery based trading, and you choose the number of shares you want to sell. And this is how you can do selling from delivery based trading. So this is how we have two types of trading. One is intraday and second is delivery based, that is long term investing. In long term investing, there is no square off done by the exchange itself. That is purely in your hands. When you want to sell a security, that you can sell. In long term investing, you cannot do short selling. Means without owning any security, without purchasing a security, you cannot sell it. So short selling is possible only in case of intraday trading, not in delivery based trading. Moving ahead, guys, I hope you have got some idea of intraday and long term. Those who have not invested in stock market or not know much about it. Here we have types of stock. That is common stock means equity shares. In India, we call them equity shares. So when you own equity shares of a company, you become one of the owners of that company, as I told you earlier, one of the shareholders of that company. And with that, you have voting rights. Whenever any decision, any strategic decision rather is to be taken by the company, not any decision related to its day to day activities or operations, but if any strategic decision is to be taken by a company, for example, diversification of business, like a company is making cement, it's manufacturing cement, and now it also wants to get into the business of producing or manufacturing iron bars. So this is a strategic decision, and for that they first need to have consent of all the shareholders, whether the company should go into diversification or not. And for that, all the shareholders are called up at one place at the company's head office, and they all have to vote in favor of this decision or against this decision. For every stock or share that you hold, you have one vote. And this is how that strategic decision either is taken based on majority of votes or is dropped. Since you are one of the owners of that company, whenever that company earns any profits, a part of that profit is transferred to your bank account, and that is called dividend. But yeah, dividend is not guaranteed, because whether company will earn profits or not, that you do not know. And even though the company has earned good amount of profits, it all depends on all the shareholders whether they really want distribution of profits among themselves or not, or they want to reinvest profits in the company itself for its further growth. Preferred stock is preferential shares. This is also kind of share. By investing in these shares, you also become one of the owners of the company, but you are not the real owners because you do not have any voting rights here. In last 20-25 years in India, no company has issued preferential stock at all. So preferential stocks, against its name, is not preferred by investors at all, because you do not have voting rights, and you are also paid dividend at a fixed rate. So even by taking a big amount of risk, you would be paid dividend at a fixed rate, and that is why they are not very popular among investors. So this is how we have difference between two types of stock. That is, common stock means equity shares, and preferential stock, that is preference shares. As I told you that most of the trading in stock market is done in equity shares only, in common stock only. And in last 20-25 years, no Indian company has issued preference shares, knowing that it is not popular amongst investors. Okay, going ahead. So we have already talked about common stock and preference stocks, that is preferential shares. Now, how to choose a company or how to choose a security in case you want to invest in that security directly without going through any mutual fund company. You understand that you have good knowledge of financials. You can read the financials of a company very well. You can analyze and interpret them. You also understand little idea of the economic condition. You understand all macroeconomic indicators, whether it is national income, that is GNP, or it is index of industrial production, or it is CPI, WPI, or the rate of investments and savings in the economy. That all you understand, the supply of money in the economy. Then you should invest directly in stock market. So for that, the basic things that you should understand, the key terms are the market price, earning per share, market capitalization, dividend yield, and many more. We will talk about them, we will touch upon them, not in detail, but to give you some idea about these. We will see these also. Okay. Market price is the price which is determined with the forces of demand and supply. So you must be knowing that in stock market, price of a security keeps changing, keeps moving. There is downward as well as upward movement every minute, and that is mainly because of the trades which are done in a stock market on that particular security. So suppose I want to purchase shares of, let's say, Infosys, and I book my trade from my screen. in that particular exchange, let's say Bombay Stock Exchange, the current market price of Infosys share is, let's say, 1500 rupees per share, but I want to buy it at rupees 1450, then I will insert a trade in the exchange, and with this the exchange will get to know that one investor is interested to invest in that share of Infosys at a lesser price than the prevailing price. If many such investors like me are there in the stock exchange, it means most of them are demanding the price to be little lower so that they could buy it, and this is how prices keep changing. Now looking at my order, that is my trade which I inserted in the exchange, the suppliers, those who already hold shares of Infosys, they may decide whether to sell the share at the existing price or they should lower it down, and this is how prices keep changing. So it totally depends upon the demand and supply of that particular security. Earning per share is the amount of profits every share has earned from the issuing company. So it is total profits earned by a company, that is profit after tax, means profits after all the expenses and tax paid to the government, divided by number of equity shares. So how much every share has earned in terms of profits, the profits of a particular year, that is called earning per share. You should not confuse yourself earning per share with the amount of dividend received by shareholders. No, earning per share is only the amount of profits which the company has earned for its every share. Out of that only the company decides, the management and shareholders together, they sit together and decide how much profit they should distribute among shareholders. And that is called dividend yield. How much dividend you actually have received out of the profits that your share has earned, that is called dividend yield. It is calculated based on the amount of dividend that you have received on each share that you hold, divided by market price of the share or the security. So suppose I have received dividend of rupees 20 and market price is 400, it means my dividend yield is 5%. That is 20 divided by 400 into 100, that is 5%. Market capitalization is the total market value of that company, of a particular company, and it is calculated by multiplying number of shares issued by that company, the equity shares, not the preference shares, equity shares, the number of equity shares multiplied with prevailing market price. So market price of a share of a company basically indicates the price of that company itself. So suppose a company has 20,000 shares and market price of its shares is rupees 400. So 20,000 into 400, that will give us market capitalization of that company. By paying that much of amount, you can purchase that entire company. That is what is the meaning of market capitalization. So I hope guys you have understood market price, earning per share, dividend yield, and market capitalization. There are some more indicators, that is price earning ratio, return on capital employed. All these are the measures of return that an equity shareholder earns from his investment. You know that with return, you also have some risk associated. In equity shares, there is absolute risk because you do not get any security from the issuing company while giving away your money, your savings to that company. So risk is always associated. So while investing in shares of a company, you should at least take care of the two things. One is the return, the expected return that you would be getting in future, and the risk associated. Now both these things are calculated with some devices, with some financial instruments, and that we will see a little bit. I will give you a little idea of that in our today's session, and that would be covered under fundamental analysis. So fundamental analysis basically is about analyzing financials of a company, including the macroeconomic indicators, which also affects financials and performance of a company. So here you analyze not only financial records, that is financial statements of a company, how the company has performed, what is its financial position, what is its liquidity, solvency, profitability position, but you also consider here the other economic factors which relate to the entire economy in which that company operates. That is, gross national product means national income, the supply of money, rate of savings in the economy, investors' behavior, consumption pattern in the economy, rate of inflation, index of industrial production, and many more. So, fundamental analysis itself includes a huge study of various factors. Based on that, only one should make his decision to buy a particular security. A little idea of that I will give you today through one contemporary case of a company. Yeah. So, the very first thing, guys, that you should do is you should check about financials of that company, and for that there are various sources available on internet these days, on web these days. I particularly use this website, that is a screener. So let me take you through quickly through this. So here I have chosen one company, that is Wipro. You can choose any company in which you are interested to invest. You want to know more about that company. For that you can use any of such websites. Here we have been given market capitalization of Wipro Limited, that is 3,19,026 crores. So this is the total market value. By paying this, you can purchase entire Wipro company. This is the meaning of market capitalization. The current market price is 305. Here you have been given high and low prices. That is, in a year, in this year, the highest price so far was 325 and the lowest price was 208. Dividend yield, I already explained you, which is given in percentage, that is 1.97. P ratio, that is price earning ratio, means the ratio of current market price, which is 305, divided by earning per share, that is P ratio. This tells how investors see this investment, the investment in shares of Wipro Limited. So the P ratio here is 25.7. It means all the investors in the market, or majority of investors in the market, they assume that this company has capacity to earn 25.7 times of its current earnings in future. Whatsoever it is earning today, 25 times of that it can earn in future. That potential this company has, and that is why the market price of this company is 25.7 times of its current earnings. Market price is not only reflection of the position of overall demand and supply of shares of Wipro Limited, but it also reflects the future potential of the company to earn profits. So how that is calculated, I will give you a little idea of that. With some calculations, ROCE is return on capital employed, that is the profits or the operating profits earned by a company on its total capital employed, that is total long term funds which are invested in the company, whether in form of owners funds or borrowed funds. So what shall be the total of owners funds and borrowed funds? 16.9% of those funds is earned by this company every year as profits. That is what is ROCE, that is return on capital employed. Book value is calculated with the actual financials of the company, that is on the basis of its net assets, means assets minus all the external liabilities, that called net assets, divided by number of shares of this company, that gives us book value. So what is the value of each share if all the assets of the company are sold off today at their book values, not at their market prices, but at their book values? Then every share will receive rupees 77.7. This is the meaning of book value. ROE is return on equity. So here we have return on equity plus borrowed funds, and here we have return only on equity. And that is 14.3%, means the profits earned by the company is the latest profits earned by the company is 14.3% of the total investment by equity shareholders. Those who have purchased equity shares of this company, of that money, 14.3% is the profit earned by this company. That is ROE. Face value is the value of a share which is mentioned on the share certificate. When you invest in a company, you receive a share certificate not in physical form but only in electronic or digital form that comes in your demat account. You might be paying more than rupees 2, but only face value is mentioned on the certificate. So this was the home screen of this Wipro. Now here you can see about the profitability. I clicked on profit and loss, and you can see for last 10-11 years its sales, which is in rupees crores. Then you can see all the expenses, operating profit margin, other income, interest, depreciation, profit before tax, tax, and the net profit. And then here EPS has been calculated. So earning per share, the latest earning per share for the year which ended on March 2024 was 10.57. And this is in rupees. It is not in crores. It is not in rupees crores. It is only in rupees. So for every share, the income earned by the company is 10.57. Out of this 10.57, the company has paid a dividend of only 5%, which is called dividend payout ratio. Here you have balance sheet. I clicked on balance sheet, and you have some balance sheet data, that is information about equity, liabilities, and assets of that company. You can see it in detail. If you want to see how many borrowings this company has, equity capital is 1,445 crores. So this is the amount of all the investors, including promoters, founders, including institutional investors like commercial banks, mutual fund companies, insurance companies, provident funds. Their collective investment in the shares of the company is 1,045 crores. Here you can see cash flows. So what I mean to say, guys, is that you should do a little research before investing into share of a company, and sources like this. Here you can get lot many information about the company. You have information about ratios, about investors, like promoters investment as on December 24 is 72.75%. Means most of the investment in common stock of Wipro Limited have been done by its promoters only. And remaining 27% is there with others, including financial institutions, public, and others. More the investment by promoters, it means there is more potential in the company. Since they have they are holding most of the shares of the company, it means they themselves believe about the prospects of the company, and therefore it is one of the indicators that informs an investor that yes, you should invest in that company. No, I'm not advocating here to invest in Wipro Limited. I'm just giving you an idea. So, guys, now we take up the case of Wipro only. I did it some time back for one academic purpose only, as how to calculate risk and return and all, and to see whether we should really invest in the shares of a company or not. And for that purpose, I picked the case of Wipro Limited and I show you some calculations here. So here I have calculated beta. Beta is an indicator that tells us the risk involved in a company. That is risk involved in investing in stock of a company. Here beta is 1.56 if you can see it here. And that I have calculated by taking past 10 years data of index value, that is BSE Sensex value, and with the value of BSE Sensex, that is index value, I calculated annual returns. And for the same 10 years, I picked the current market price CMP of Wipro, and out of this, I calculated returns. Like here, return in 1 year. For example, on 31st March 2020, 2013, you purchased one share of Wipro at 437.15, which was its current market price then. In on 31st March 2020, 2014, you sold the same share when the price was 542.6. It means the annual return that you earned is 24.12%. The same way I calculated return year on year, the same returns I calculated for the entire index, that is BSE Sensex. And with these returns, I calculated the beta. Beta, as I told you, is an indicator of risk involved in that company. More the beta, more is the risk involved. Now, after this, I calculated cost of equity. It is little technical thing, guys. I'm not very sure how many of you are able to understand, but I just wanted to take you through this little quickly so that you can understand how we can value a stock. So you yourself can value a stock if you have a good knowledge of financials. You can yourself value a stock and then can decide whether you should really invest in that stock or not. For example, if you're correct with your correct valuation, if the value of a stock is lesser than the current market price of that stock in the market, it means that stock is overpriced and you should not buy it. However, if the value that you find with your calculations is more than the current market price of that stock, it means the stock is underpriced by the market. You should buy it because in some time the prices will go up in the market and you would be able to sell it at a higher price. So this is how usually analysts in stock market and capital market take decisions, and they advise others also where to invest, where to hold, and where to sell the securities. Okay. To calculate cost of equity of Wipro shares, we first calculated beta as I explained you here. And then for calculation of cost of equity shares of Wipro, I have used capital asset pricing model, CAPM, where we take return of a risk-free asset. So KF that I have mentioned here is return of risk-free asset, and the risk-free asset that I have taken is our central government's 10 years bond which the central government issued in the year 2024, and it would be maturing in the year 2034. That is GS Government Security 2034. The return on these securities, that is the coupon rate or interest rate promised by the central government, is 6.79%. So every year government for the next 10 years from 2024 till 2034 would be paying 6.79% on that. It is absolutely risk free. Why? Because behind these government bonds or government securities, there is central government and there is no chance of failing it. Whosoever is the political party in power, that does not make any sense. Ultimately, it is issued by the central government. So this is how we always pick risk-free return being into any economy, whether you are in India or in America or in any other country. Government securities are picked, usually 10-year securities, securities which would be maturing after 10 years. So that 6.79 I have taken here, that is KF in my this equation. If you see this equation, then it is multiplied with beta. So this portion, that is KF plus beta multiplied with KM minus KF, if you could see it here, this part, this basically is the risk premium. Since in shares of Wipro, there is risk because Wipro is not giving me any collateral once I invest in its shares. And that is why risk is always involved here. It is not as good as 10 years government securities issued by the central government. So for that, I expect more returns than what otherwise I could have got by investing in government securities. And the returns that I have calculated, which is known as cost of equity of shares of Wipro, is 15.928%. For this, I have taken 6.79, that is return of a risk-free asset, and then I have added this with the risk premium. Risk premium is product of beta of Wipro and the difference of market return and return from the risk-free asset. That is difference of 12.64, which you can see here. It is highlighted here. So 12.64 minus 6.79 multiplied with beta plus 6.79 is giving me 15.928. It means my expectation from Wipro's shares is that every year it will earn me profits at the rate of 15.9% or 15.928%. Since Wipro also has long-term borrowings, which I showed you here, if you see, they have some long-term borrowings. On September 24, they had long-term borrowings of 6,265 crores, means they have raised funds in form of borrowed funds as well. When you have borrowed funds in your business, you again have financial risk known as financial leverage because you have to pay every year interest on these borrowings at a certain rate, irrespective of your profits. And this burden you will always have until you repay all your long term borrowings. So, here I have calculated cost of debt, that is the cost of borrowed funds to Wipro. So, what is the annual cost of these borrowings to Wipro that I have calculated? And for that, I first checked the credit rating of these borrowings, and that is triple A rated borrowing by Wipro. There are many credit evaluation agencies in the market, whether it is ICRA or CARE or many more, or Moody's and all, and S&P and all. They all do the rating of debentures or bonds issued by a company or a government. And based on their rating, most of the investors decide to invest in that company. Triple A is very good rating. It means there is less risk in investing in debentures of Wipro. These rating agencies also publish credit spread, which is 0.67 here that I have mentioned here. So cost of debt is calculated using that credit spread by adding it to the risk-free return. So risk-free return from the government securities is 6.79. To this we have added the credit spread, and this is how we have got the cost of debt, that is cost of long-term borrowings of Wipro. Means the borrowings that we just saw on the other screen, on that every year the burden that Wipro has to pay as interest is 7.46%. So with cost of equity and cost of debt, here we have calculated weighted average cost of capital. Here I have taken equity, which is 1,445 crores, and debt is 6,230 crores. So total long-term funds employed in Wipro is sum total of these two, that is 7,275 crores. And cost of equity, which we calculated here, is 15.928%, and cost of debt is 7.46. With that, I have calculated weighted average cost of capital, that is on average every year Wipro has burden to pay 8.67% on the total funds of 7,275. This is the meaning of weighted average cost of capital, which I have written here as WACC. So the burden to pay dividend and interest to shareholders and lenders is 8.67 percentage. Now to know how much profits the company is earning and what are the potentials of profits, for that I have taken free cash flow technique, where I have taken net profits, NI, that is net income, or PAT, that is profit after tax, means net profits, for 2 years with a difference of 10 years. I have taken depreciation, and this is how I have got free cash flow, that is net income plus depreciation, means 7991 plus 1060. The same is for the year ending 2031st March 2024, so that I could know what is the growth in these cash flows. So the growth in cash flow, that is this cash flow, the net cash flow which is coming in the company, the money that is being received by the company by selling its goods and services, has grown by 4.83% in the last 10 years. And it's a good indicator that there is a growth in the financials of the company, in the financial performance or income of the company. Here we have EPS for 2 years with a difference of 10 years, that is EPS of 31st March 2024 and EPS of the year ending on 31st March 2014. And with that also I have calculated the growth rate. So growth in the EPS is 5.75%. Now here I have calculated intrinsic price per share, intrinsic and relative price. With this, finally we will see whether the stock of Wipro is overpriced or underpriced. And based on that, you can take decision to invest in the shares of Wipro. Intrinsic value is calculated based on the future cash flows of the company, means in future from 2024 year onwards, how much cash flows would be received by the company. Like in the year 2023-24, the cash flows were 14,919 crores, 14,519 crores. So based on the growth rate, that is 4.8393%, we calculate intrinsic value, and the future cash flows which the company will have, means the future, in future the money, that the net money after considering all its expenses, the net money received by the company by selling its shares that are called future cash flows that we have discounted to know its present value. Some of you must be knowing about present value and future value concept of money. You know that because of the passage of time, value of money keeps changing. You must have studied, some of you, that under time value of money, commonly known as time value of money. So using that, I have calculated intrinsic value, where I have taken the latest cash flow, that is 14,519 crores. I have also considered the growth rate because this will grow at the rate of 4.83% that we have seen with the historical data. Then I have discounted it at the cost of equity, which we calculated here. Cost of equity here is 15.928%. So since I'm expecting 15.928%, with that I have discounted it, with that rate I have discounted it. I have also considered here growth rate and then finally divided it by the number of shares in crores. So this is how the intrinsic value per share of Wipro is 262.71. When we talk about relative price means how Wipro's share is performing or how the entire Wipro company is performing as compared to its peers, whether it is Infosys or TCS or some other software company. That is called relative valuation for each share of a company, and that is 399.12. And for this, I have used here the P ratio of the entire industry to which Wipro belongs. So this 37.36 is the P ratio, price earning ratio of the entire software industry that I have picked from here, peers. Median P as of now is 32.21, and this I picked, guys, but it has changed because I did my analysis around 2 months back. So from here you can choose the median price earning ratio of all the companies falling in the same industry, whether it is TCS or Infosys or HCL or L&T Mindtree or Tech Mahindra or any other, right? So using that, we have got the relative value of each share of Wipro, and that is 399.12. So what for this what I have done is that I took the P of the entire industry, the median P, that is 37.76, and that I have multiplied with earning per share of Wipro, that is 10.57. So when earning per share is multiplied with price divided by earning per share, it gives you price, and that is called relative price of share of Wipro. Based on this intrinsic value, I have done the valuation of Wipro Limited, that is 262.71 multiplied with total number of shares in crores, which is 522.51 crores. And this gives me the market value as per my intrinsic valuation. And market value of Wipro as per relative price, that is 399.12 multiplied with 522.51, that is number of shares of Wipro. With that, the relative value of Wipro is 2,08,545 crores. The other way to find risk involved in Wipro is to calculate its operating and financial leverage. For that, I have picked operating profit, that is 16,572 crores. This one. Then earning before tax from the financials of the company, which is published. We have just seen that. Then annual interest expense, that is 1,255 crores. And then I calculated EBIT, that is earning before interest and tax. Many of you must be knowing about this term EBIT, EBT, PAT, and all. So by adding earning before tax with interest, we got the EBIT. Now this is interest coverage ratio, ICR, that is EBIT divided by annual interest, and that is 12.72. So As far as paying its interest on its long-term borrowings is concerned, Wipro is in a good position because its profits are 12 times or more than 12 times of its annual interest liability. Now here I have calculated operating leverage OL, FL that is financial leverage and CL that is composite or combined leverage. That is also an indicator of risk involved in the company. Operating leverage is about operating risk, and operating risk is more when you have more of fixed cost in your business. Financial leverage is more when you have more of borrowed funds in your business. Operating leverage here is 1.04, financial leverage is 1.08. So these I have calculated here. And by multiplying operating and financial leverage, we have got overall composite or combined leverage, which is 1.13. And this is close to the beta that we calculated here, that is 1.56. So this is how we do the valuation. Now, the intrinsic value with my calculation is 262.71, whereas relative value is 399.12. When I was doing this analysis, that time, current market price of Wipro was around 325 something. It means that time the share was overpriced. Because as per my calculation, it is 262.7, but that time it was around 300 and some other amount, little higher of 300. So I found that the share of Wipro is overpriced. If you see the price of Wipro now, you will find that it is 305, means it has come down. Earlier it was high when I was doing my analysis. It means to some extent these analyses really work, guys. Many analysts, many fundamentalists, they still rely on these, and there are various theories which you can learn. In case you are not much interested into knowing financials, then you should not directly invest in the stock market, especially in equity shares, because there is a lot of risk involved. Now you must be wondering that you must have heard from many that they earned this much amount, that much amount, a huge handsome profits they earned very recently in the stock market. But you will surprised to know that since 1980, when the very first time BSE index was made, popularly known as Sensex, that time its value was 100 in 1980, and today the value is 77,505. This is the current value of Sensex. So from 100 it has come to the level of 77,505. You must be knowing that you must be understanding that the profits are very high. But if you see in last 10 years in BSE, the profits earned by investors is only 11%. In last 5 years, it is 10%. In last 1 year, it is in negative because by the end of 2024, the Sensex value was 78,139. Today, it is much lower than that, though we have just started with the year 2025. So I should not rather consider and talk about it. But in last 5 years, the overall return from BSE Sensex is only 10.17%. Since 1980, that is in the last 45 years, the returns are only 15.93%. So you should be very careful, very conscious before investing in stock market, right? The way it looks, it's not so in reality. I go back to the presentation part. Okay. So how to invest in stock market? For that, you need some resources. The very first thing that is you should have some savings, some surplus money, and that should be in surplus. And you, even though you lose that, you will not get much affected. Then only you should invest with that kind of money only in stock market. Then you should have a bank account. You should be a major that is above 18 years of age. You should be a national of India. You should have a demat account. You can have that, as I told you earlier, through a bank or any stockbroker. You should have membership of a stock exchange, whether it is BSE or NSE. Most these days, most investors give you, while opening your account with them, they give you membership of both, so that you could trade in both BSE as well as NSE, that is National Stock Exchange and Bombay Stock Exchange. So once you have the membership, once you have the demat account with you, using that demat account, you can do intraday trading as well as delivery based trading. I quickly show you if it is possible now, because it's okay. And once you invest in stock or share of a company, you have to monitor it very consistently, so that you do not lose, because you know that the prices move very fast in any direction. You may miss an opportunity if you do not keep a watch on the market, on the prices. So monitoring of your stock performance is also very important to be a wise investor. Okay, now what you should do and what you should not do, that we have covered here. So you should research before investing in stock market. You should diversify your portfolio. Diversifying your portfolio means do not keep all the savings, or do not invest in only one security, not only in one type of security. So when we say diversify your portfolio, it means you should pick stocks of different industries, so that even some industries do not operate, do not work, do not perform well in a particular period, from the from the returns of other industries where you have invested, your overall return sets off and you do not get affected much. That is what is diversification. So you can diversify in construction, in banking, in insurance, in IT industry, in fast moving consumer goods. So this is how you can diversify your portfolio. Apart from this, diversification also means investing not only in equity but also at the same time in some safe funds like debentures and government bonds. So with this, you can minimize the risk of your overall portfolio. Then you should stay updated with the stock market trends. So there may be sudden fall in the stock market, or there may be a surge in the stock market, very a rise in the stock market. So you could take you get in cash from an opportunity, and for that you should be updated with the stock market trends. You should always invest for long term. Do not do any short term trading at all, because this market is not only to earn profits. People also lose a lot in this market. You also have to follow SEBI regulations, but that you do not need to be much worried of, being an individual investor, because that part is taken care by your broker through whom you do the trading. What you should not do is do not do do not make decisions of buying, selling, or holding a security on the basis of some tip or some rumors, which most people do. So do not do that. Avoid emotional trading. Again, the same thing. Out of some emotions, you decide to sell a share which has very high potential, and if you sell it now, later you may regret when its price really goes up. Don't put all money into a single stock. That is about diversification of your portfolio. Avoid excessive leverage. Leverage, we just talked about financial and operating leverage that you should be uh, well versed with. Using excessive leverage also means that you should not invest in a stock market much by borrowing, because on the borrowing, many people borrow from banks, and they believe that the interest that they have to pay on bank loan is much lesser than what they could earn from the share market. So that also you should not do. You should be very wise while doing so. You should understand what is the rate of interest that you have to pay to the bank on a loan out of which you would be investing in stock market, and what is the expected return that you would be getting from a particular stock in which you are going to invest. Again, the risk the risk associated with that stock, that also you should consider. So that is the last thing, that is don't ignore risk management. So we are done guys with this now. If you have any questions, I have taken you through the last part little quickly. I know that because many of you might not be understanding some technical part. But in case you want to learn more about it, we can have another session for it, a detailed version of technical analysis and all, fundamentals and technicals and all. So I'm done with my part, students. Priyanka, I hope you are there. In case students have any question, they can ask. Priyanka, can you hear me? Students,
Yes, Amit.
yeah, yeah, yeah. Priyanka, I
Okay,
was.
so yes, so dear students, hope you all had a good time with the session. Is there any doubt or something? We see no doubts. What is Nifty and Sensex is one. Yes, Sabri, please go ahead and ask your query.
Okay, so Nifty and Sensex, I tell you this quickly, I respond to this quickly before we take up any other question. They are two different index. One is of BSE, that is Sensex is of Bombay Stock Exchange, and Nifty is of National Stock Exchange. In Nifty, we have 50 shares. The most, those shares which have the maximum market capitalization, the same way in Bombay Stock Exchange, Sensex, we have 100 scripts or 100 shares with the maximum market capitalization. So these 100 number of shares or in Sensex or the 15 Nifty, they keep changing based on the market prices. You know that market capitalization is based on market price. So when price of a share is more than the other, then it comes in the Sensex, and the other one whose prices are low, it gets away from the Sensex. 100 companies are part of BSE Sensex, and top 50 companies are part of Nifty of NSE based on their market capitalization. So if you could see any other question, Priyanka, that also we can take up. I just explained it, Amrita, what is Nifty and what is Sensex. I hope you got me. Priyanka, are you there? Priyanka, are you there?
I'm sorry, my mic was off. I was speaking.
Okay, okay, no issue.
Yeah, so there's one question which is SGB a good investment? Which side would you recommend to invest from?
Which one?
SGB,
No, I should not comment on any specific
any
investments.
kind of particular
Right,
stock,
right,
yes.
right. I'm sorry to say, but it would not be fair to, you know, have to talk about a particular step now, this session, right? It is purely academic session, so that we should avoid as of now.
Yeah, so I think, Amit, there is some glitch from your end, the network or voice, something is breaking. Another question is, sir, how to analyze when to invest and sell?
Yeah, so when that I already explained, when you first need to do valuation of the stock that you want to buy. In case the current market price is more than the value that you get through intrinsic valuation or through relative valuation, then you should not buy. Means the stock is overpriced in the market, and in case its market price is lesser than your valuation, then you should buy it because that time it is underpriced. Am I audible, Priyanka?
or not, or where to find the right audience. Now, I will go ahead and put the chat box again on off mode, and we'll start sharing all the links. So kindly bear with me for some time more, and then probably we'll wrap up the session. So, as I was saying, thank you so much, Amit ji, for joining and giving us such an insightful session. I was actually talking to somebody else, some other mentor, and they were asking what's in today's session. So when I mentioned stock market, even they were interested. They were like, "Oh, we should have joined to gain some more knowledge." So hope
Yeah.
these sessions of Elevate master classes, which are conducted on weekends, are bringing some relief, some knowledge, some addition to your current knowledge. So for that fact, I will be sharing Amitji's LinkedIn ID with all the dear students. Please go ahead and connect with him, and he's our in-house mentor as well. So if you think what he taught was good, and what we are doing is great, you may come and take up one of the programs with us if you think so. This is helping in any way. So, and apart from that, if you wish to stay connected with us, this is our Insta, LinkedIn handle. You can find more information about such sessions which we conduct every Sunday 6 p.m. You all know, you've been a part of it from last 1 year or even more. So this is the LinkedIn, all information, exclusive information, who's the speaker and everything is mentioned here. So it would be easier for you guys to go ahead and connect with people and stay connected with us as well. So please go ahead and follow. I'll be sharing all the required links and taking all the doubts once I'm done sharing the links. So that's about it. Requesting you guys to stay connected with us. And yes, so if you liked the session, right, guys, you can copy this link and save it. And later on, go ahead and drop a comment. This is how you grow your LinkedIn. This is how you know, show what you're doing in your learning phase, which is your college days. Yeah, hold on. I will turn on the chat box and then we'll take all your queries. Meanwhile, just allow me to share the important links with you so that you don't miss on anything, because this is important, right? So apart from that, we have official masterclass group, official WhatsApp group for these masterclasses. You all can go ahead and request to join. So there are two groups, just to let you know. In some of you will already be a part of either EduTalk 1 or 2. So this is for the new people who are there to receive all the information. And if you're a part of one, you'll not be allowed in two, because both the groups get similar information, exactly copy pasted information. It just the limit of the group is over in group one, so hence we have created group two. So please go ahead and request to join. You can't directly join, but you can request to join. And once, because I am the admin of the group and I'm in the session, I will allow you guys once I'm free from this session, right? So this is about it. And we have an official channel also of Elevate, wherein we drop some important information about jobs, some insights from the market, and a lot more. And if you think you want to stay connected with the host, which is me, Priyanka, all you can do is just click on the link on LinkedIn and send me a connection request. Would be more than happy to connect with you and help you out with whatever we can, right? Now comes your favorite part, which is the participation certificate, guys, for which you all come here for. So I'll just go ahead and share the participation form.
Priyanka,
Abhishek's number is listed. Yes,
Priyanka, I'm
Amritji,
sorry.
bata.
Yeah. I was just asking, since you were talking to students, I'm really sorry to interrupt you in between.
No
But
problem,
can I
please.
take a leave if I'm not required now?
Yes, yes. Thank you so much, Amirji. It was pleasure having you here today on our
Thank you,
masterclass
Priyanka.
session.
Yeah, and
And yeah,
thank you all.
students can't say no, yes or no. I just turned on the chat box, guys, for you. Go ahead and just say bye to your mentor, and then probably we'll continue with our chit chat separately.
Thank you, students. It was a nice, very nice meeting with you all, and you were very calm and patient. And I hope Priyanka will, divert me all the questions to me
Yes.
so that later I could address it. I'm really thankful to you, to Priyanka, and to Elevate also. Thank you,
Thank
guys.
you, sir. Thank you so much for
Yeah.
joining. We will shortly catch up again with these students for another advanced level session. Yeah.
Thank you. Thank you, Priyanka. Bye. Bye.
And thank you, sir. Thank you. Bye bye. Please take
Yeah.
care.